If you own bonds in 2022, you probably watched them lose 13% or more in your safe investments. The reality is, rate cycles come and go, and we could see similar conditions again. After fielding many calls from clients that year, I realized most people don't understand 7 critical things about bonds. Today, I'm answering the exact questions that help you calmly navigate any interest rate environment. Bonds are supposed to be boring, right? The safe part of your portfolio that lets you sleep at night. But after spending the last few years explaining why safe bonds lost 13% during 2022, I realized something. The financial industry has been teaching bonds all wrong. The same 7 questions keep coming up, and the standard answers are incomplete at best and dangerous at worst. What I'm sharing today comes from real conversations with hundreds of retirees who learned these lessons the hard way. We'll cover 7 bond questions that could save your retirement, from why rates and inflation create a double whammy to how pension funds protect themselves and how you can too. I'm particularly excited to show you question 7, where you'll learn to build your own inflation hedging income stream in about 20 minutes. This isn't theory, it's what actually works when your financial security is on the line. Number 1, why do bonds lose value when interest rates rise? This is the question I get more than any other when interest rates rise quickly. You bought a bond fund paying 2%, rates jumped to 5%, and suddenly your investment is showing double-digit losses. What gives? Here's the simple math that changes everything. When you own a bond, you're essentially holding a contract for future payments. Let's say you own a 10-year bond paying 2%. If new bonds start paying 5%, nobody wants your old 2% bond at full price. They'll only buy it at a discount that makes up for those lower payments. The key number to understand is duration. Think of it this way. When the 10-year Treasury rate rises 1%, your bond loses roughly its duration in percentage terms. So that 15-year bond fund, a 1% jump in the 10-year rate could mean a 15% hit to your fund. A 2-year bond, same rate increase, but your loss might only be 2%. This is why some bonds lost 20% during the last rate spike and others barely budged. This is where mainstream generalizations get dangerous. A 2-year bond and a 20-year bond might both casually be called bonds, but they behave like completely different investments when rates move. Same asset class, totally different risk profiles. Let's move to number 2. Why do interest rates spike when inflation hits? Once you understand this connection, bond market moves start making sense. When inflation rises, the Federal Reserve has one main tool, raising interest rates. They're trying to cool down the economy by making borrowing more expensive. It's like tapping the brakes on a speeding car. But here's what catches bond investors off guard. This creates a double whammy. First, your existing bonds lose value, as we just discussed. Second, inflation eats away at your future purchasing power. So that 2% bond you bought, if inflation runs at 5%, you're actually losing 3% each year in real terms. This is why 2022 was so brutal for so many. Inflation hit 9%, and the Fed jacked up rates faster than any time in the last 40 years. But here's the opportunity most people miss. Tilting toward a shorter duration fixed income portfolio creates an inherent hedge against future inflation. Yes, in falling rate environments, that hedge works against you, but we've found that rising inflation tends to hurt retirees more than falling inflation or deflation, so the protection can be worth it. It's not about avoiding bonds, it's about owning the right ones. Number 3 brings us to a critical distinction. Why did your bond funds lose money, but your neighbor's individual bonds didn't? This difference could save your retirement. Bond funds and individual bonds are completely different animals. A bond fund never matures. It's a basket of many different bonds with various maturity dates, so the fund as a whole has no fixed maturity date. When rates rise, the fund must mark down its holdings immediately, and those losses show up in your account. If you panic and sell, those losses become permanent. But individual bonds, they have a superpower, a fixed maturity date. Even if your bond drops 20% in value at any point, if you hold it all the way until maturity, you get your full principal back plus the interest payments along the way. Your neighbor probably owns individual Treasury investments or CDs, certificates of deposit. While you were watching your fund balance drop daily, they were calmly collecting interest, knowing exactly when their money comes back to them. Here's the real kicker. With individual bonds, you control your destiny. You decide when to sell, if ever. You know exactly what you'll receive and when. With a bond fund, you get whatever the market price is when you need your money, which could be at a significant loss if rates have risen recently. This brings us to number 4. Should you own treasuries or corporate bonds? The answer might surprise you. Corporate bonds usually pay higher yields than treasury bonds. That seems like free money, right? A 5-year corporate might pay 6%, while a Treasury pays 4.5%. But here's what that extra yield is really buying you: risk. Credit risk, to be specific. When the economy weakens, companies can default. Remember 2008? Corporate bonds crashed while treasuries soared. Treasuries have a unique advantage. They're backed by the US government that literally prints money. The same government that helps create inflation also guarantees your principal. It's a circular protection you can't get anywhere else. Plus, treasuries are completely liquid. You can sell them any day the market's open without worrying about finding a buyer. But what if the government defaults? Look, the government is among the strongest, if not the strongest borrower on the planet. If treasury payments stop, your portfolio will be the least of your worries. We're talking about a scenario where the entire financial system collapses. That's not investment planning, that's doomsday prepping. It all depends on your individual circumstances, but generally we're a big fan of treasuries for the core of a retirement portfolio. That extra 1% to 2% from corporates sounds nice until you realize it could evaporate in a crisis, exactly when you need stability the most. Save the risk taking for your stock portfolio and consider letting your bonds be truly safe. Number 5 is where everything comes together. How do you know which bonds to buy for your retirement? This is where we steal a page from the pension fund playbook. It's called asset liability matching, but don't let the jargon scare you. The concept is simple. Match your bonds to when you need the money. Need income in 2027? Buy a bond maturing in 2027. Planning a big trip in 2030? Get a bond that matures in that year. It's like creating your own personal pension. Most people in retirement do this backwards though. They buy random bonds or funds and hope it works out. But when you match maturities to spending needs, magic happens. Market volatility becomes irrelevant. Interest rate changes don't matter. You've engineered certainty into your future cash flows. Here's a practical example. If you need $50,000 per year for the next 10 years, you'd buy 10 different bonds, each maturing in successive years. As each bond matures, it funds that year's spending. No selling required, no market timing needed. This is how pension funds ensure they can pay retirees for decades, and you can do the same exact thing for yourself. Of course, your specific circumstances will determine the exact approach. Factors like your tax situation, your income sources, and spending flexibility all play a role. In fact, there's a specific way to implement this strategy that I'll show you in question 7, and it only takes about 20 minutes to set up. Which leads us to number 6. Is the 60-40 portfolio actually dead? Everyone's saying it, but I think they're wrong. The 60-40 portfolio, 60% stocks, 40% bonds, built wealth for generations, but most people simply implement it wrong. For the bond side of it, they buy the aggregate bond index, which is full of long-term bonds that get crushed when rates rise. No wonder 2022 was the worst year in modern history for 60-40 portfolios. Here's the fix. Consider replacing those long-term bonds with 1 to 7 year treasuries. Same allocation, completely different result. Short-term treasuries provide stability without the interest rate and inflation risk. When rates rise, they actually benefit as they roll over into higher yields later. Instead of using a one-size-fits-all bond index designed for the average investor, you're customizing the portfolio for a retiree's specific needs. Shorter time horizons, inflation and healthcare concerns, and income requirements that the average 30-year-old, for example, doesn't face. This modified approach using shorter-term bonds has historically shown more resilience during rate spikes. While traditional 60-40 portfolios with long bonds suffer losses when rates and inflation rise, portfolios tilted towards shorter duration treasuries tend to experience much smaller drawdowns. Remember, past performance doesn't guarantee future results, but understanding these historical patterns can help inform your strategy going forward. The 60-40 portfolio isn't dead, it just needs bonds that work in today's environment. Don't throw out a proven strategy, customize it to your specific situation. Finally, number 7. How do you create guaranteed cash flow in 20 minutes? Remember the asset liability matching strategy from question 5? There's a specific way to implement it that pension funds have used for decades, and you can set it up for yourself in about 20 minutes. It's called a Treasury ladder, and it's simply a series of bonds maturing in successive years. You can build one through any major brokerage. Here's the 20-minute process. First, decide how much income you need from your investment portfolio and for how many years. Let's say $50,000 annually for 10 years. That's $500,000 total. Next, divide that amount by the number of years. With 10 years, you put $50,000 into bonds maturing each year from 2026 to 2035. As each bond matures, you can either spend the money or reinvest it in a new 10-year bond, maintaining your ladder indefinitely. The beauty is that you're constantly reinvesting at current rates, providing natural inflation protection. Log into your brokerage account, search for Treasury bonds, sort by maturity date, and start buying. Focus on bonds trading near par value to avoid tax complications. Within 20 minutes, you've created a predictable cash flow stream that adjusts for inflation automatically as bonds mature and get replaced. It's not complicated, it's just systematic. This systematic approach works beautifully for retirement income planning. While everyone else worries about the Fed's next move or inflation report, you've got guaranteed income locked in as rates change and your ladder adapts automatically. And the best part? When the stock market goes through a drawdown, you can rest assured you've got many years of living expenses locked in through your bond ladder strategy. This brings excellent peace of mind and behavioral discipline into your retirement portfolio. You won't be forced to sell stocks at the worst possible time just to fund your lifestyle and pay your bills. Here's what's interesting. When retirees actually do the math on building a proper bond ladder for their spending needs, they typically end up with a portfolio that's around 50 to 60% stocks and 40 to 50% bonds. Sound familiar? 60-40. That's right. You've essentially rebuilt the classic balanced portfolio, but this time with bonds that actually protect you from inflation and rate changes. The old wisdom wasn't wrong, it just needed better execution. So there you have it. 7 questions that can transform your bond strategy. From understanding duration to building your own treasury ladder, you're now equipped to handle whatever interest rates throw at you. If you're ready to see how this fits into a complete retirement plan, click the link in the description below. You'll find free tools to help you implement what you've learned today, plus a transparent look at how we approach retirement planning and who we serve. Or stick around for another video if you'd like. Either way, I hope this helped you on your retirement planning journey. Thanks for spending this time with me.